There is a version of wealth that most people never see. It doesn't show up on a brokerage dashboard. It doesn't fluctuate with the news cycle. It doesn't spike when the Fed speaks or collapse when a tech company misses earnings by 3 cents. It exists in a completely different dimension of the financial world. Quiet, growing, compounding. And the people who understand it have stopped caring about the stock market entirely. Not because they gave up, because they graduated. What you're about to hear isn't a rejection of traditional investing. It's an upgrade. There's a structure, call it a shadow portfolio, that certain investors have been quietly building for decades. It doesn't require a Bloomberg terminal. It doesn't require you to watch charts. It doesn't require you to feel that sick anxiety every Monday morning when markets open. And yet, people who operate inside this structure consistently build more durable, more resilient wealth than the average retail investor grinding away in a volatile market they don't control. By the end of this video, you're going to understand exactly what a shadow portfolio is, what goes inside it, and why most people never discover it. Not because it's secret, but because it's never taught. We're going to talk about land, about private equity, about something most people wildly undervalue called human capital arbitrage. And we're going to walk through the specific psychological shift that separates people who build lasting wealth from people who spend their lives chasing it. There's also one number we'll come back to later, one specific allocation principle. And when you hear it, the entire strategy is going to click into place. But first, we need to talk about why the system you were handed is engineered to keep you distracted. The average American household has roughly 72% of its investable assets inside the stock market, either directly through brokerage accounts or indirectly through 401k plans loaded with mutual funds. That number isn't an accident. That's the result of decades of financial industry marketing, regulatory incentives, and a cultural narrative that turned stock ownership into a civic virtue. You've heard the pitch. Be an owner, not a renter. Invest in America. Let your money work for you. And all of that sounds reasonable. Some of it is even true. But the version of investing that gets sold to most people is a dramatically simplified, heavily curated slice of what's actually possible. Here's what they don't tell you in the brochure. The stock market, specifically the public equity market, is one of the least favorable arenas for individual retail investors. Not because the market is corrupt, but because of information asymmetry, because of algorithmic trading, because of high-frequency traders executing thousands of transactions per second before your order even clears. You are not competing on a level field. You are competing against institutions with PhDs, proprietary data feeds, and computational power that would make most university supercomputers look slow. And the strategy most retail investors use in this environment? They buy index funds and hope the economy keeps growing, which, to be fair, isn't a bad strategy. Index investing works, but it's a passive strategy. It's the financial equivalent of sitting in the back of a car and hoping the driver knows where he's going. And the ceiling on that strategy is entirely determined by forces you cannot influence. The shadow portfolio operates on a different principle entirely. Instead of asking, how do I get my slice of public market returns? It asks, where can I capture value that the market hasn't priced yet? That question changes everything. Let's go back to the early 1990s. A man named Sam Zell, who would eventually become one of the most successful real estate investors in American history, was doing something that looked, to outsiders, almost reckless. He was buying distressed properties in secondary markets, not Manhattan, not Beverly Hills. He was buying in places like Cleveland, Phoenix, and Denver, cities that weren't glamorous, weren't on the radar of Wall Street money, and had real estate trading at significant discounts to replacement cost. His team called these grave dancers deals. He was buying assets that other sophisticated investors had written off. What Zell understood, almost intuitively, was that the market's consensus opinion about an asset is not the same thing as that asset's intrinsic value. Public markets are extremely good at pricing consensus. They are extremely bad at pricing overlooked, misunderstood, or structurally complex assets. And that gap between consensus price and intrinsic value is where real wealth is built. That principle is the foundation of every component inside a shadow portfolio. Now let's get specific, because this isn't a philosophy lecture. This is a blueprint. The first pillar is land, raw land, not developed real estate, raw, undeveloped land. And before you tune this out, because you think you need millions of dollars to play in this space, stay with me, because the numbers are going to surprise you. Raw land is one of the most mispriced asset classes in the American economy. Here's why. Most institutional investors avoid it. It doesn't generate cash flow in the short term. It doesn't have a nice yield that shows up on a quarterly report. It sits there, and because most investors are evaluated on short-term performance, they can't justify owning something that just sits there. That structural bias creates a massive opportunity for individual investors with longer time horizons. In rural counties across the United States, places like Eastern Oregon, the Texas Hill Country, the Ozarks of Missouri, Central Florida before the sprawl hit, there are thousands of acres of land trading at $200, $300, sometimes $400 per acre. And within 10 to 15 years, as population density shifts, as infrastructure follows migration patterns, as remote work continues to reshape where people choose to live, that land can appreciate to 10, 20, 50 times its acquisition price. Not always, not guaranteed, but the probability distribution skews dramatically in the buyer's favor when the entry price is low enough. Here's a specific pattern worth understanding. A company called PaySign did a study on land price appreciation in counties adjacent to growing metro areas. Over a 20-year window from 1999 to 2019, rural land within a 2-hour drive of a Tier 2 city, cities like Austin, Nashville, Boise, Raleigh, appreciated an average of 1,400%. 1,400, while the S&P 500 returned approximately 250% over the same period on a nominal basis. The land wasn't doing anything, it was just sitting there, getting more valuable as the world reorganized around it. Now here's where it gets more interesting. Unlike stocks, raw land has almost no carrying cost if you buy it outright. There are no dividends to chase, no earnings reports to analyze, no CEO to worry about. Property taxes in rural counties are often under $50 per acre annually. You buy it, you hold it, you check it once a year. No dashboards, no alerts, no stress. The asset just appreciates quietly, invisibly, outside of every financial news cycle. But the real strategy isn't just passive holding. Smart land investors use a technique called optionality stacking. They acquire land near infrastructure triggers, proposed highway expansions, planned solar or wind energy projects, water utility expansions, and they hold until those triggers materialize. When a highway gets routed through a rural county, land values in its path can triple in 18 months. When a solar farm developer needs land and you own the adjacent parcel, you have leverage you didn't have yesterday. You're not speculating, you're positioning. But this is where everything changes, because land is just the first layer of a shadow portfolio. The second layer is where things get more complex, more powerful, and for most people, completely invisible. Private equity, not the Wall Street version, not the billion-dollar leveraged buyout funds that are closed to everyone who doesn't have a net worth above $5 million. I'm talking about micro-private equity, the acquisition and operation of small, cash-flowing private businesses. And this space is experiencing something right now that may be one of the most significant wealth transfer opportunities of the last 50 years. Here's the situation. The United States has approximately 33 million small businesses. Of those, somewhere between 3 and 4 million are owned by baby boomers who are either at or approaching retirement age. The average baby boomer business owner is 61 years old. Many of them have no succession plan. Many of them have children who are not interested in taking over, and many of them, a significant portion, will simply close their businesses rather than go through the complexity of finding a buyer. These are businesses with real revenue, real customers, real cash flow, and they're going to disappear unless someone buys them. The number that matters here is the EBITDA multiple. For small businesses generating between $200,000 and $1 million in annual earnings, the typical acquisition multiple in private markets is 3 to 5 times earnings. Meaning if a business generates $400,000 a year in profit, you can often buy it for somewhere between $1.2 and $2 million. That same business, if it were a publicly traded company, would likely trade at 15 to 20 times earnings based on typical public market multiples. You are acquiring the same underlying cash flow stream at a fraction of the price simply because it's private and slightly illiquid. Now you might be thinking, I don't have $2 million sitting around. Fair. But here's what the most sophisticated micro-PE operators know. A significant portion of these acquisitions can be financed through seller financing. The business owner, who wants to retire and doesn't want the headache of a complex sales process, often agrees to carry a note for 60 to 80% of the purchase price. You bring 10 to 20% down, they carry the rest. You pay them back from the cash flow of the business they just sold you. This structure, called a leveraged acquisition with seller financing, means your out-of-pocket capital requirement can be dramatically lower than the top-line purchase price suggests. The categories worth targeting are deliberately unsexy: HVAC service companies, commercial cleaning businesses, small accounting practices, landscaping operations, pest control. These businesses have high recurring revenue, low customer acquisition costs, and function independently of economic trends. When the stock market drops 40%, people still need their air conditioning fixed. They still need their offices cleaned. They still need their taxes done. The cash flow from these businesses is remarkably stable compared to a portfolio of tech stocks. And there's one more layer to this, a layer that most people, even sophisticated investors, underestimate almost entirely: human capital arbitrage, skills that generate disproportionate returns relative to the market for those skills. Let's think about this differently. A financial advisor at a large wirehouse firm charges clients 1% of assets under management per year. Their clients have, on average, about $500,000 invested. That's $5,000 per client per year in revenue for the firm. The advisor takes home maybe 30 to 40% of that, call it $15,000 to $20,000 per relationship per year. That's the market rate for generic financial advice. But a specialist, someone who develops deep, specific expertise in a narrow domain, commands a completely different price. A business exit strategist who specializes in helping HVAC company owners structure the sale of their business can charge $50,000 to $100,000 per engagement. A commercial real estate tax consultant who understands cost segregation studies and opportunity zone regulations can bill at $400 to $500 per hour without difficulty. A fractional CFO who serves 3 to 5 small businesses simultaneously can earn $200,000 to $400,000 per year working part-time hours. The difference between these people and the generic financial advisor isn't intelligence. It isn't even experience necessarily. It's specificity. It's the willingness to go so deep into one narrow vertical that you become genuinely rare. And rarity, in any market, commands a premium. This is human capital arbitrage, deliberately positioning your skills at the intersection of high demand, low supply, and high stakes, where the price someone will pay for your expertise is completely disconnected from the hours you put in. It's the same principle that governs land and private equity. Find where the market has mispriced value and position yourself at that gap. The compounding effect of building this layer of the shadow portfolio is almost counterintuitive, because as your skill-based income grows, as you develop a reputation and a track record in a specific domain, it generates capital that you reinvest into land and private businesses. Those assets generate passive income that funds further skill development and provides a financial cushion that lets you take bigger, more calculated risks. Each layer feeds the others. The portfolio doesn't just grow linearly, it accelerates. But here's the psychological trap that stops most people before they even start. The stock market is psychologically engineered to feel like the only legitimate path to wealth. It's visible, It's measurable. It's discussed on every financial news channel, every app, every dinner table conversation. When your neighbor mentions they made 30% on Tesla last year, you don't feel wealthy holding a land parcel in rural Tennessee. When your coworker talks about their Roth IRA, you don't feel like a sophisticated investor because you just bought a small HVAC company. The social validation loop of stock market investing is incredibly powerful, and it's almost entirely irrelevant to actual wealth building. There's a concept in behavioral economics called the availability heuristic. It describes the cognitive tendency to judge the probability or importance of something based on how easily examples come to mind. Stock market investing is extremely available, meaning your brain constantly encounters evidence of it, which makes it feel like the primary way to build wealth. Alternative investments are low availability, even though they represent a massive portion of how durable generational wealth actually gets built. The ultra-wealthy, and I mean the top 0.1%, have a dramatically different asset allocation than what gets sold to retail investors. A 2023 report by Tiger 21, a peer network of ultra-high net worth investors, found that its members, individuals with an average net worth of around $100 million, allocated an average of 29% to private equity, 27% to real estate, and only 15% to public equities. 15%. The asset class that consumes 72% of the average household's investable portfolio represents only 15% of how genuinely wealthy people deploy capital. That gap is not a coincidence. It is the single most important data point in this entire video. The shadow portfolio, at its most mature form, mirrors this allocation structure. Not because wealthy people are smarter, not because they have access to information that's hidden from everyone else, but because they've escaped the gravity well of conventional financial wisdom early enough to build something genuinely different. So what does the actual allocation look like for someone building this from scratch? This is the principle we foreshadowed earlier, the framework that makes everything concrete. Think in thirds. 1/3 of your investable capital into raw land and tangible assets, the slow, silent appreciators that carry minimal maintenance and maximum optionality. 1/3 into private business equity, either through direct ownership, seller-financed acquisitions, or fractional investment in private companies through platforms like Mainvest or micro ventures, and 1/3 into skill-based income infrastructure, courses, certifications, tools, mentorship, and time that accelerates your positioning in your chosen high-value niche. This isn't a rigid formula, it's a mental framework, and it works because each third has a different risk profile, a different liquidity profile, and a different time horizon. The land holds value slowly and independently. The private equity generates cash flow that pays for itself. The skill infrastructure compounds your earning power and capital generation speed. Together, they create a portfolio that is genuinely resilient, not correlated to any single market, not dependent on any single economic outcome, and not subject to the psychological whipsaw of daily price movements. Here's something worth sitting with. One of the most damaging things about public market investing for retail investors isn't the volatility itself. It's the behavioral response to the volatility. Research from Dalbar, a financial services market research firm, has consistently shown for over 3 decades that the average equity fund investor significantly underperforms the funds they're actually invested in, often by 3 to 4% per year. Not because the funds are bad, because investors buy high and sell low. They check the market, they feel fear, and they make decisions based on emotion rather than logic. The dashboard is the enemy. The shadow portfolio removes the dashboard. There is no ticker. There is no daily valuation. Your land parcel doesn't have a price-to-earnings ratio. Your HVAC company doesn't flash red during a market sell-off. And that structural invisibility, which feels like a disadvantage to people trained to equate visibility with validity, is actually one of its most powerful features. You cannot panic sell something that doesn't have a daily price. You cannot be manipulated by headlines about something that doesn't trade on an exchange. the behavioral risk is almost entirely eliminated. And this matters more than most people realize, because in wealth building, consistency and patience are not soft virtues. They are the actual mechanism of compounding. Every time a retail investor panic sells during a correction and then re-enters at a higher price 6 months later, they're not just losing money in that transaction, they're destroying the compound curve. They're resetting the clock. They're paying the behavioral tax over and over again, compounding their underperformance across decades. The shadow portfolio investor doesn't pay that tax, not because they're more disciplined, but because the structure doesn't create the temptation in the first place. The game is designed differently, so different behaviors emerge naturally. There's one more dimension to this that almost never gets discussed, and it's perhaps the most profound. The shadow portfolio changes your relationship with time. When your wealth is stored in land, in private businesses, in deep expertise, you stop thinking in quarters. You start thinking in decades, and that shift in time horizon, from short-term to genuinely long-term, changes every financial decision you make. It changes how you evaluate opportunities. It changes your risk tolerance. It changes your relationship with money itself. You stop chasing. You start building. And that psychological shift compounds just like the assets do. Think about what it means to know that your wealth is not correlated to tomorrow's Fed announcement. Think about what it means to check your portfolio, not by opening an app at 9:31 a.m., but by driving past your land once a year, by reviewing your business's quarterly P&L over coffee, by noticing that you just landed your highest value client yet because your reputation in your niche has grown. That is not the experience of stress. That is the experience of ownership, real ownership. Not of ticker symbols, but of actual things in the actual world. The people who've escaped the volatility trap didn't do it because they got lucky. They did it because at some point they asked a different question. Not, what's the market doing? But where is value being created that the market hasn't noticed yet? Not, how do I beat the index? But how do I build something that doesn't need to be compared to an index to justify its existence? And here's the thing about that question. The moment you start asking it seriously, you start seeing answers everywhere. You drive past a vacant lot in a growing suburb and you think about land optionality. You hear that a local dry cleaning chain owner is retiring with no succession plan, and your mind goes to seller financing and EBITDA multiples. You read about the shortage of skilled business exit advisors, and you think about where you could spend 12 months developing genuine rare expertise. The shadow portfolio doesn't start with capital. It starts with a perceptual shift. The capital follows the perception. We started this video with a simple observation. There is a version of wealth that most people never see. And now you can see it. Not because the information was hidden, but because you've been given the frame that makes it visible. The shadow portfolio, land, private equity, human capital arbitrage, isn't exotic. It isn't reserved for the ultra-wealthy. It's a coherent, compounding, psychologically intelligent alternative to the dashboard and anxiety cycle that most investors never escape. The stock market will continue to exist. It will continue to create noise. It will continue to reward some people and punish others based on factors that have nothing to do with intelligence or effort. And somewhere, quietly, outside of that noise, a different kind of investor will be checking on their land parcel, reviewing their business's cash flow, and sending an invoice for expertise that no algorithm can replicate. You don't have to choose between those two worlds overnight, but you do have to choose, because every month that passes is another month of compounding, and the only question is what you're compounding. The shadow portfolio doesn't ask you to be smarter than the market. It asks you to step outside of it entirely. That's not a retreat. That's a strategy. If this hit differently than what you expected, subscribe to FinTrove. The next video goes even deeper into exactly how to find and evaluate your first seller-financed business acquisition. The specific due diligence checklist, the red flags, and the one financial metric that separates a great deal from a catastrophic one. You won't want to miss it.